The next presentation is Preqin 2020 market recap. And with that, I'm going to see if Jesse is on the line with us. Jesse, are you with us?
I'm here. Thanks, Michael. And good
Oh,
afternoon, everyone.
thank you. Thank you very much. Can you project your screen? Can you project your presentation?
I can. Yes. I'll get it up right now. Can we see that?
Yes, we can. And before you start, I want to thank Preqin for being involved with Flyer for over the past 5 years. It's been a great partnership for us. And, I'm really grateful to have you involved and to share these overviews on a regular basis. I think this is like the fourth or fifth one. I also want to encourage the audience that if you have any questions, please use the Q&A function. And hopefully, Jesse, you have some extra time at the end of the presentation. With that, I'm going to turn it over to you, Jesse. Thank you.
Yep. Thanks, Michael. Really happy to be here and kind of be a part of the Fly family here. And good afternoon, everyone else. Welcome to the Preqin portion of today, which is the 2020 market recap for private debt and real estate. As mentioned, my name is Jesse Fahy. I serve as the Vice President of Private Capital for Preqin. And in that role, I'm in charge of data quality and content for the Americas. It's a pleasure to be here again speaking with you all. It was a tumultuous 2020 to say the least, with the pandemic having a heavy impact on nearly every aspect of life. The alternative assets industry was no different, seeing big shifts in investment activity and a redefinition of business as usual while we tried to adapt to the new normal. It also offered a chance to showcase the innovative nature and overall resiliency of alternative assets, which I'll look to highlight here for you today. Taking insights from Preqin's global reports, which were released last week, I'll deliver a 2020 review for private debt and real estate, showing the current state of play, as well as where we might be headed in 2021 and beyond. First, for anyone who's not unfamiliar with us, Preqin is the leading provider of alternative assets data globally. From our 13 offices across the world, we cover each of the main alternative asset classes through a lens of fundraising, performance, deal activity, and investor sentiment. Over nearly 20 years in business, we've managed to achieve this through a combination of top-notch sourcing of all public information, as well as the relationships our more than 300 research associates have built over that time. And so with that out of the way, we'll dive right in, starting with our private debt overview. The 2010s was a period of tremendous growth for private debt, going from a nascent asset class around the GFC to now the third largest in private capital and quickly approaching $1 trillion in total assets. The meltdown of the financial sector in 2007 and 2008 was a launching point for private debt, as we know it today, with new regulatory controls like Dodd-Frank and Basel III, forcing banks to deleverage their balance sheets and leaving an opening for alternative loan providers to step in and fill the void. Since then, private debt has more than quintupled in AUM from $138 billion at the start of 2007 to sitting just under $900 billion through the midway point of 2020. As for where those assets are held, private debt has been a space traditionally dominated by North American managers and North American focused lenders. 538 of the $884 billion of private debt AUM is held by North American focused funds, but Europe has been closing the gap in recent years and served as a true growth region for the asset class. Overall, North American private debt is becoming a more mature market, so European managers and crucially Asian managers are who we expect to drive future growth. 2020 was not an easy year by any means, but despite the many challenges private debt managers faced, they still managed to deliver on a strong year for fundraising overall. For the fifth consecutive year, private debt funds closed on over $100 billion, split between more than 200 funds during the course of 2020. During the GFC, we saw an abrupt run-up in fundraising, fueled by the need for new lenders and powered by the closings of some mega funds between 2006 and 2008. In recent years, private debt has had much steadier fundraising progress, and the success of 2020 points to maturity and staying power for the industry. Private debt was able to produce strong results, unlike most of the other asset classes, and still close on a large number of funds instead of relying entirely on mega funds for new capital. The impressive fundraising performance comes despite some rather lackluster distribution figures from private debt managers. Unlike most private capital asset classes, net cash flows for LPs from their debt portfolio has been flat or negative for most of the past decade, with capital calls coming faster than debt managers can return it. That was made abundantly clear in 2019 as net cash flow fell to its lowest level since 2008. But negative cash flow is not due to lack of performance, but rather private debt is a victim of its own fundraising success, scaling at such a rapid rate that managers are calling capital for new funds before they're able to exit and return capital to investors. That speaks to the great confidence that LPs have in the asset class, that they're willing to keep allocating large chunks of capital before their initial investments are realized, and the importance of private debt in the late cycle especially. Capital calls will likely be depressed in 2020, but that could set us up for a huge year in 2021 as valuations normalize and dry powder is sitting at $330 billion. While not as dramatic as during the GFC, when average fund sizes neared $1 billion, private debt has always been a top-heavy asset class, with the largest funds taking a lion's share of capital raised each year. 2020 was no different, as the 20 largest funds closed this year captured more than half of all capital raised for the year, and those outside the top 50 in size, took home just over 20% of the total. Most notably, among the funds that closed is HPS Investment Partners, which closed their 2019 vintage mezzanine fund in October of last year for a whopping $11 billion, making it the second largest private debt fund ever raised. We also had Clearlake Capital and Blackstone GSO close on funds larger than $5 billion. And overall, the average fund size in 2020 was the highest on record other than during 2007 and 2008. A silver lining within the overall capital concentration is that first-time funds did not noticeably suffer despite the adverse market conditions. In 2020, first-time fund managers made up 20% of all funds closed and about 10% of capital raised, which is more or less on par with where it had been each year for the latter half of the last decade. The downside of capital concentration is that can lead to conformity of ideas and stifle innovation for the industry. The fact that we're still seeing a healthy influx of new managers year over year in a mature market, much less the one that we had to deal with handicapping of social distancing and the pandemic, really shows healthy turnover and a willingness by LPs to stay on the lookout and connect with the best possible managers. Deal making, on the other hand, fell for the second consecutive year, and deal volume is down by more than 600 from the 2018 highs. On one hand, 2020 isn't too far off from 2019's numbers. As we look to collect more data, it'll probably be closer to the next 2 years in terms of overall numbers once it's all said and done. On the other hand, it's the lowest volume since 2013 and a very abrupt slide after a record 2018. So it's definitely something worth monitoring, even with the pandemic as a large contributing factor to the poor results from last year. One possible explanation is the relatively low dry powder levels within the asset class, at least relative to how much has been invested in recent years. 2018 was a record year across the board, so 2019 might be a natural cooling off period after so much investment, and then the combination of the pandemic and social distancing is artificially depressing the market in 2020. A strong fundraising year coupled with low deal activity has given private debt managers a chance to bolster their dry powder reserves, which have been growing and now sit at $330 billion as of February 2021. The large war chest, coupled with pent-up demand post-pandemic, could set us up for a banner year in private debt investments for 2021 and leave the 2019 and 2020 dip as a distant memory by year's end. So that's how the asset class has been performing so far, but what does that mean for where private debt could be headed? From the fund manager side, optimism abounds as we've seen a large number of funds rushing to market over the course of the past year. In total, we have around 550 funds seeking to raise just under $300 billion as at the start of the year, easily record numbers on both accounts. In particular, direct lending and special situations funds have seen a surge in popularity over the course of the past year. Direct lending is the largest strategy in private debt overall, and at the moment, they represent roughly half of all funds currently in market. Comparatively speaking, special situations is a much more niche strategy that has seen a spike of interest over the last year, fueled by the pandemic. In total, the number of special situations funds in the market has increased more than 5-fold in the last 12 months. So managers are clearly seeing a lot of investment opportunities for the strategy and expect LPs will start to allocate capital accordingly. Overall, fund manager optimism is sky high. Granted, it was a lackluster fundraising year in 2020, but going into this year, funds in market are targeting more than 2.5 more in aggregate capital than what was raised all of last year. Most importantly, Half of all funds currently raising are ones that launched in the last 12 months. So rather than being intimidated by the pandemic, managers are clearly seeing a lot of opportunity in the current market and have been rushing to raise a new fund so that they can take advantage. Fund manager optimism is only half the equation, but looking at the stated target allocations that LPs have for private debt, it should figure to be a great year overall for fundraising. Other than family offices, every single investor type that Preqin tracks is currently showing an underallocation of private debt, some by as many as 3%. Assuming allocation targets hold steady, that should represent a huge amount of available capital for debt managers, and a large spread of investor types means that there should be opportunity for a wide array of different fund managers. Within those allocation figures, LPs are really targeting a reliable income stream and high risk-adjusted returns that they feel private debt can provide for their investment portfolios. Looking back from the GFC onwards, I think private debt has largely done a good job in providing that for their LPs, compared against our wider alternative asset class indices, as well as the S&P 500. Private debt has provided middle-of-the-road returns overall, falling short of the lofty totals earned by private equity, infrastructure, and public equities. However, it still far outpaced natural resources and real estate, the latter of which took a long time to recover from the GFC. Rather than absolute returns, the key to private debt is consistency. And you can see over this timeline, private debt had relatively low correlation to some of the market downturns in the last decade, while providing consistent, reliable returns for their investors moving forward. In fact, median net IRR for the asset class has hovered between 8 and 9% every vintage year this past decade, a reliable investment that institutional investors crave. Within those steady returns is also the opportunity for outperformance if you invest with the right manager and strategy. For top quartile private debt funds, you get return profiles that look much more aligned with the high absolute returns of private equity. And even for the poorest performing managers, you can still expect returns north of 5% in IRR each year. That consistency, coupled with the chance for high returns, has made private debt a mainstay in institutional portfolios. And based off our recent conversations with GPs and LPs, that shows no signs of stopping anytime soon. Of fund managers we surveyed at the end of last year, 46% said they saw investor appetite for private debt increase. An additional 23% saw they saw appetite significantly increase over the past 12 months. That increased appetite is clearly fueling manager optimism and is one of the driving forces in the surge of funds entering market last year, along with the additional investment opportunities that have opened as a result of the pandemic. Over the longer term, we expect those allocations to continue, with nearly half of LPs saying that they intend to increase their allocations to private debt, and only 10% say that they will reduce their allocations to the asset class. That glowing optimism on both sides, along with a strong track record of performance, is why Preqin projects private debt to be the second fastest growing asset class in alternative assets over the next 5 years, behind only private equity. We did these projections in Q3 of last year and pegged private debt to grow at 11.4% CAGR between now and 2025. And even though we have it pegged as the second fastest growing, these projections might end up being overly conservative, as we didn't predict such a fast bounce back from the pandemic. Already, AUM in 2020 has outpaced what our predictions were a few months ago, so it's quite possible that private debt AUM sits well above $1.5 trillion once we reach the end of 2025. I know there's a lot of information, so we're going to do a quick recap before moving on to private real estate. It's worth stating again that private debt is currently the third largest alternative asset class in private capital, having amassed nearly $900 billion in AUM as at the midway point of 2020. The lofty AUM total was achieved through a decade of strong fundraising performance, including 5 straight years of more than $100 billion in capital raised. A lot of that capital has been funneled to the top, however. In 2020 alone, 39% of all capital raised went to the 10 largest funds closed that year, including the second largest private debt fund in history by HPS. Deal value last year was more or less on par with 2019 figures. However, both years are sharp declines from the previous record high we'd seen in 2018. This is caused by a variety of factors, but dry powder levels have been historically low compared to the recent record investment years, so managers likely needed some time to rebuild their capital reserves. That could be achieved quickly in 2021, as fund manager optimism is sky high, with funds in market targeting $300 billion in aggregate capital, and over half those funds were launched in just 2020. The huge number of funds in market, combined with growing investor appetite, bodes well for the future of the asset class, which we project to grow at the second quickest rate among alternative assets and reach the $1.5 trillion mark by 2025. Hope you found the debt market overview helpful. We'll now be moving on to the next portion, covering private real estate. Real estate is one of the more mature asset classes, having long been a part of institutional investor portfolios. And as such, it sits only behind private equity and hedge funds as the third largest overall. The last few years have been particularly good for growth in the asset class, which now sits at $1.1 trillion at the midway point of 2020. This is made all the more impressive as real estate was the hardest hit following the GFC. So the past decade saw real estate managers bounce back nicely, and they now have nearly $400 billion in dry powder ready to invest. That huge growth in AUM and healthy dry powder figure is in large part due to the impressive fundraising over the past few years. Fundraising has been incredibly strong, clearing $100 billion in capital raised in each of the last 7 years, with 2019 being the best year yet with a record $179 billion raised. It took a while, but the asset class has been raising capital at pre-recession levels since 2015, along with a healthy number of funds closed each year. Unfortunately, 2020 real estate did not prove as resilient as some of the other alternative asset classes, and overall fundraising took a significant hit last year. In total, fundraising was down $60 billion and over 200 fewer funds closed in comparison to the record 2019. By aggregate capital raised, it was the worst year since 2013, a big step back from what had been a red-hot fundraising market. The recent strong run of fundraising years really checks out when looking at the influx of cash LPs have been receiving from their real estate investments. From 2013 onwards, LPs have been net cash flow positive each year, with distributions in excess of $200 billion between 2015 and 2019, peaking with a net positive capital inflows of nearly $100 billion in 2016. Since then, distributions have lagged as capital calls have climbed higher, leading to net cash flows closer to zero in 2018 and 2019. 2019 also saw a record year for fundraising, so clearly LP's attraction to real estate lies beyond simple net cash flow. But with a down year in 2020, coupled with negative net cash flow, it's reasonable to wonder what 2021 could have in store for us. From a fundraising standpoint, 2020 saw basically every real estate strategy get a big reduction from the previous year, with opportunistic funds cutting their fundraising by half. The only strategies that outperformed their prior year results were core plus and secondaries funds, the latter of which could see an interesting market open up for them, with valuations taking a big hit in the pandemic and some investors looking for flexibilities within their portfolios. While it's still definitely top heavy, real estate doesn't have nearly the issue with capital concentration that we had seen with private debt. The 50 largest funds have accounted for more than half of fundraising each year, but there's still a lot of capital left over for smaller fund managers to take advantage of. However, smaller real estate managers seem to have been greatly affected by the pandemic overall, as smaller funds captured their lowest share of total capital this decade by a significant margin. Compounding that issue is that first-time funds had a very difficult time attracting any capital last year. Only 5% of aggregate capital raised went to first-time fund managers, almost half the proportion they were able to capture during the record fundraising year in 2019. That isn't really a surprise. Social distancing made fundraising process very difficult for all parties involved, and that issue would only be made worse by new managers without experience raising capital or existing LPs that they could re-up from on a new fundraise. But along with the increase in capital concentration, these are two troubling signs for the asset class as a whole and could make it difficult to fully bounce back in 2021. The private real estate deal market had been on fire coming into the year, with almost 10,000 deals in both 2018 and 2019, to go along with 3 consecutive years of aggregate deal values in excess of $440 billion. 2020, in comparison, has seen a sharp decline, with deal volume after Q1 being positively anemic, and in total for the year falling nearly 40% from 2019. And it hasn't discriminated by property type, with every sector taking a steep haircut compared to the prior year, and totals down across the board. Of the group, industrial property types saw the smallest negative impact of the bunch, and they could prove to be an important area moving forward. Real estate managers are already drawing up their 2021 game plans on how to rebound from COVID-19, and it looks like many of them will be targeting residential and industrial property types, with 90 and 80% of managers we spoke with respectively saying they would be the sectors they target this year. Data centers and healthcare also figure to be important areas of investment, while unsurprisingly, hotels, office, and especially retail will not be a focus for any managers. Retail is already being hit hard with a switch to online shopping, and each of those three sectors could see some profound market shifts away from them as a result of the pandemic and how it's been affecting societal norms. There's no way around it. 2020 was a brutal year for private real estate, but looking forward, what should we expect from the asset class? There does seem to be a bit of optimism for private real estate fund managers, as a significant number of new funds launched over the past year, and in total, there are nearly 1,000 funds looking to raise capital globally. Between them, they are targeting $314 billion in aggregate capital, which isn't a huge increase from 2020, but still a lot of money being sought from LPs. The larger problem is due to the lack of fundraising that took place in 2020. We're left with a glut of funds that have been in market for over a year. In total, nearly 2/3 of funds currently raising have been doing so for more than a year, and 17% have been trying to close their fund for over 2 years. These old funds, mixed with new entrants in 2020, means that funds in market today are trying to raise 2.6 times more capital than was raised in all of 2020, the highest such ratio we've seen since the global financial crisis. It's simply a very crowded space, and for an asset class that was already having issues with capital consolidation and first-time funds, it makes for a bad combination in the 2021 environment. On the bright side, allocation targets to real estate tend to be high across all investor types, and there are a lot of LPs out there that are currently under their target allocation. In particular, banks and corporate investors are some institutional investors that have big gaps in their target allocation plans and could look to invest aggressively to close it. That might not be the most attractive target for small or emerging fund managers, but the additional capital investment should help the entire industry. Results from our recent LP survey would also point to another year of capital concentration for private real estate. 94% of investors we spoke with said that they would be investing solely or make at least half their allocations to real estate managers that they've already invested with. Granted, 54% of those said they would split between re-ups and new managers, but that's still a lot of money going to the same firms. In addition, 83% of investors we surveyed said they'd only be investing in 1 to 2 real estate funds over the course of 2021. Overall, it could be difficult for a manager to attract capital if they don't already have happy LPs from a previous vintage fund. 2020 is a tough year overall, and 2021 could also prove to be difficult. But over the long run, real estate will continue to be successful because it's such a core part of investor portfolios and allows you to target returns in line with your risk profile. Here we see a risk return plot for various real estate strategies, where size of the bubble represents AUM, the x-axis is median net IRR, and the y-axis is the standard deviation of that IRR, or in this case, the risk. With a few exceptions, you can almost plot a straight line through these strategies and pick and choose what return profile you would like to see. Each of the main strategies also has a decent amount of assets behind it, showing plenty of LP interest, no matter the property type. As was the case with private debt, consistency is a key selling point for real estate investors, and that has largely been something real estate managers have been able to deliver on. Looking back over the course of the past decade, median IRRs between 10 and 15% could be expected pretty routinely across vintage years, with the clear outlier being the global financial crisis. Both the lead up to and the recovery from the GFC had led to some big outliers in real estate return profiles. However, returns normalized quickly after. Unfortunately, the current downturn also looks like it will have a large effect on real estate returns, to the point where managers are already starting to price this into their projections. Of managers we spoke to, more than 40% are expecting real estate asset pricing to have a negative effect on their future returns, with some saying it will negatively affect their return expectations by 10% or more. Making the issue worse, it seems like managers and investors are not fully aligned in this view, with managers having a strong belief that asset prices are overvalued, while investors don't have any consensus on the matter. That disconnect could make for even more difficult conversations in what was already shaping up to be a difficult fundraising year in 2021. But again, over the long term, real estate is a core asset class for institutional investors, and they'll continue to allocate. 90% of investors are looking to maintain or increase allocations to real estate over the long term, which should continue to drive growth, even if the current environment is a difficult one. And as such, we expect real estate to continue growing over the next 5 years, albeit at a modest 3.4% CAGR in that period. Our overall modeling errs towards the conservative side, and this number might be small, but it's taking into account 2 key factors going against it. First, real estate's missing one of the key areas that's powering AUM growth for other alternative asset classes, and that is interest from Asian investors. We expect private equity, infrastructure, and private debt to grow in Asia between a 20 to 30% rate. However, we're only projecting 3% growth for Asian real estate through to 2025 rather. And then finally, 2 of the largest sectors in real estate are retail and office space, which both face very uncertain futures and should continue to weigh on the asset class. So quickly, as a summary of what we've discussed, real estate is the 3rd largest alternative asset class overall, with over $1 trillion in AUM, and it's coming off a great decade in which it returned more than $320 billion to investors since 2013. This year, however, real estate has really felt the effects of the pandemic, with total capital raised down 34% from the prior year, and the fewest total number of funds closed since 2011. Overall, this has hit opportunistic funds the hardest, although every strategy is down compared to last year. For the funds that did find success, it was mainly the largest players, with the 50 largest funds closed in 2020, capturing 3/4 of aggregate capital raised. Deal volume was similarly affected, with volume down by about half from the prior year. 2021 might continue to be choppy, but managers are targeting residential and industrial property types in their near-term investment plans. For our fundraising outlook, there are more than 1,000 funds trying to raise capital at the moment, but the crowded space with low turnover might make for a difficult fundraising environment overall. And then lastly, we're looking further ahead. While real estate will remain popular with investors, we project only modest AUM growth for the asset class, weighed down by low interest from Asian investors, as well as poor performance from retail and office properties. And that concludes the session for today. I think we're right at the 1 o'clock mark. So Michael, I don't know if we have any time for questions or if we need to move on to the next session.
I need to move on to the next session, Jesse. What I will do is I will get you a list of all of the questions and contact information. One question that we had come up has to do with the presentation. If you can send me a copy of the presentation in PDF and give me permission to share it with those that are asking for it, I would really appreciate it. And as always, the feedback on your presentation today was very, very positive. So thank you very much. And to those of you that are asking for more information, we'll be sending around an email where you can download his presentation, or you can view his presentation on the Preqin website. So again, thank you, and we welcome you back